Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Jeff Kilburg, CEO of KKM Financial, for an update on what's going on in the markets in what was a very busy week. We have the S&P 500 up 3% on the week, its best performance since March. Nasdaq Comp up 4% on the week, its best week since March, up 8 weeks in a row. Jeff, I mean, despite all the economic data, pause with the Fed, a little bit more hawkish longer term, with a number of some key earnings. I mean, the market's just taking it in stride. So my question to you is, has anything fundamentally changed, or is this a case of momentum begets momentum?
I think it's momentum and it's sentiment flip, but you're absolutely right, Jill. We've talked a lot here on Trade Talks about this range that we were stuck in. We were tethered to 4,000 for quite some time in the S&P 500, over 250 days. And sure enough, we were cautiously optimistic here at KKM Financial about that breakout to the upside. We had the breakout above 4,200, kind of even blinked at 4,300, and sure enough, 4450, which was a technical target of ours, was achieved today. We saw, as the market opened up, 4,447 was the print in the S&P 500 futures. So it's just remarkable to see some of the bears having to tuck tail. I guess bears don't have the biggest tail, so maybe that's not the appropriate analogy, but nonetheless, they had to wave the white flag, right? They had to cover their positions. You saw a huge gamma squeeze yesterday, and that was really the melt up feel that we had in the marketplace. Is this sustainable? We'll have to see, but to your point, we got over earnings season, which was better than feared. The pause came in, the debt ceiling debacle was put away. So right now, I think going into the summer hours, we're feeling pretty good, despite the fact that some of the bears out there are trying to beat their drum later, but they're getting pushed into their cave. Bears are going into hibernation, unfortunately.
Yeah, but you know what, the move up, though, to your point, was predicated on better than expected earnings. If earnings were not that good, then it would definitely be a head scratcher, but companies are performing, they're adapting in this environment. And you and I were talking about this off camera. If you're a money manager and your mandate is to have a diversified portfolio and so forth, and you're indexed to the S&P as an example, if you were not, or had not enough exposure in those 7 to 11 names that have really been driving the market, I mean, you have to put money to work, I guess, in those names so you don't get fired at the end of the year.
No, absolutely. I think we will see some shifting in money managers due to the fact that they've missed out on this, or they thought they were a little bit smarter than they actually were in 2022. And what's interesting, if we take a step back and look at 2022, Jill, we saw some of these stocks get punished, specifically the Nasdaq-100 names. They were oversold. Maybe there's some tax loss harvesting in December, which pushed the Nasdaq-100 lower, down 35% year to date. But that snap back, we've talked about on TradeTalks for quite some time. You still need exposure to tech, how you own it. Certainly, if you're a stock picker and you had Oracle, you had NVIDIA, you had some of these names in Facebook, for example, but having that broad swath exposure, or more importantly, walking away from tech last December, that was a fatal mistake for many wealth managers.
My favorite thing to say is that you cut your teeth in the bond market pits. How has the fixed income space responded to the pause and the outlook that the Fed is taking a more hawkish stance?
Well, that's been the guiding light, and I continue to go back to the 10-year note. Certainly, we've seen the curve inverted, but that's by design. The Fed has really tried to slow down or make that cost of capital more expensive on the front of the curve. But the 10-year note, the guiding light has been, we saw some tranquility coming in the marketplace after a historic move in rates higher, right? We go back to 2022 in January, it was 1.5%, popped up to nearly 4.5%. And what have we seen in the last 6 to 8 months? We've seen some tranquility. We saw it tethered to 3.5%. I don't think anyone really saw the regional bank chaos, if you will, push the 10-year lower, but that's exactly one of the catalysts that has had the ability for fixed income, specifically the treasury market, to calm down. When you see a calmer treasury market, the ripple effect is that equities feel a little more certainty, a little more comfort, and you see buyers come back to the market. So we are not done with this meltdown, by the way, Jill. I think we're at the end of the month with 2 weeks, end of quarter. All those money managers that were softly criticizing for being out of the game, they're going to be putting money to work here. They're chasing performance now. They have to, they're forced to, otherwise they will find a little pink slip in their email inbox. But nonetheless, I think the market is going to continue to move higher. 4,600 was always a 2023 target, because remember, we haven't talked about it yet, but I love bringing this up. This is the post year after midterm election. And historically speaking, Jill, the S&P 500 does very well in a post midterm election year.
Well, it's interesting that you say that, because activity we're seeing in the options market seems to confirm that there is still more room up on the Nasdaq-100 to the upside. Even looking further out, we had Kevin Davitt, our head of Nasdaq index options, on just before you, and he's seeing levels in skew in the money and out of the money that we've not seen in 10 years. And we know what the market did over the past decade, with the exception of the pandemic blip in 2022. So longer term, there's some suggestion from options traders that there's more juice in the index.
I agree. And I think we saw historic call option volume this week. We've never seen this many calls trade. That's part of the gamma squeeze yesterday. But nonetheless, people are trying to position now that we have so many of these hurdles, so many of these obstacles cleared. Will we see the markets move higher? I get a little nervous when you see some of the bears start to flip a little bullish. So we're looking at actually buying some downside protection, booking some profits synthetically, using option overlay. So I think now is the time as we go into the end of the quarter while people are chasing. I think it's time for us to reposition slightly and continue our cautious optimism. But there is an opportunity here when people are chasing. It's the same way when we saw people selling down in October. That was an opportunity to buy some of these names like a Tesla, like an Nvidia, like an Oracle.
All right. Appreciate the insight as always, Jeff. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.